In the last session, we talked about the Fed and how you're expecting it to cut. And we also had a look at the dollar index and how it was moving with our expectations. In the last session, we talked about the dollar index and we also talked about what the Fed was expected to do, considering we had an FOMC meeting last week. And this was very well explained on the chart. We were still expecting that we'd see a downtrend on the dollar index. We also covered the BOJ and the interest rate differential that we talked about earlier in our Market Watch episode. In this episode, we're going to cover that and so much more, and we're going to also see what's happening with the US stocks. My name is Samson Mzera, and welcome to this session of the Market Watch series, where we tell you what's happening, the news and the charts, and we keep you up to date on what to expect. So be sure to like, comment, and share this video. We've had the dollar index come down from this level over here, where it has been consolidating for a while. And we remember talking about how we expect that trend to continue, and well, it has. And we also talked about the Euro USD pullback, in which case we're expecting that continuation of that long-term upwards trend. Well, what is happening in the markets? We did have the FOMC last week, and this is what gave us a broad guidance. During the meeting, it was pretty clear that they were intending to cut rates, and they were introducing the market to that language and that rhetoric about beginning to cut. And two key things stood out for us. The first is the fact that they're now having a more balanced approach. Remember, they used to focus so much on inflation, and now at least they're focusing on both inflation and employment. And indeed, on Friday, the employment data did have a very huge impact on the market. We did see that downwards push on the dollar index because of that NFP reading, and we also saw the charts react in other markets. For example, the euro also had a big bounce. So why is that the case? We did hear that during the meeting, they're now more than ever confident that data is in line with what they expect or conditions they expect for an interest rate cut, and we just needed a little bit of confirmation for that. So the next two key points were very key, and the two key points were number one, the NFP data, and number two, the inflation data. So the NFP data is in line with signs of a cooling down economy and signs of a slowing down economy. And this is why the markets had such a huge rally downwards in terms of the dollar index. It's because now we are even more certain that based on this data that is coming out and based on what they said during the meeting, then definitely the market is now starting to fully price in a September cut. And this is why you're seeing the dollar weaken. So that continuation of the dollar index downwards might most likely stay as is. So traders will be looking at key levels, any sort of imbalances, and any levels lower past this price as potential targets. So we have a very interesting level at 103.3. So if at all the market retraces to that level, then that should be halfway of that imbalance level that we're seeing, or that extension downwards. So if you're looking to trade, for example, a continuation of the trend, those levels along that extension might be very interesting to look at. So for example, if you use your fib levels, or if you use any type of supply demand pattern within that extension, then that might be a very good area to see if sellers might start coming in again. We also have an interesting level at 102, I think 0.5 or 0.4, and this is where we have a key support level for the dollar index. So if at all things continue as is, then we should see the dollar index rallying to this point later in the day. However, if we start seeing the news change and sentiment change, then we might see a retracement back to that imbalance. And that's what traders will be looking at the moment. And speaking of retracement and slight strengthening of the dollar, we might have some reason to believe that tensions in the Middle East are worth monitoring, especially now that we have Iran threatening war with Israel. So that might be a good cause to believe that we might start seeing a flight to safety, for example, on the dollar, or even more importantly, on gold, which now makes a very good pairing in terms of the fear factor in the market. Now, the most interesting chart and why it's been rallying and traders and having traders excited is the USD JPY chart. Now, in this chart, we have that difference in policies between the BOJ and the Fed, and this is making a perfect combination for reversal of that entire uptrend we've been seeing in USD JPY. So that continuation is looking highly likely that it will last for some time, now that the Bank of Japan, or the BOJ, has started hiking rates and being a bit more tighter with policy. So this is expected to continue because for a central bank, once the decision changes from easing to tightening or vice versa, they're more likely to stay with that or stick with that decision for some time or for a couple of years. So in this case, traders have been unwinding all the shorts they've been having on the Japanese yen, and now it looks like there's going to be some strength in the Japanese yen, and coupled by the fact that we are expecting the dollar to weaken because of the Fed policy, then it forms that combination of a downwards trend in the market. So we'll be looking at any signs or more data to confirm that this downtrend is going to continue. And in the charts, we'll be looking for signs of pullbacks or momentum entries or continuation in line with the trend. Lastly are the indices, and we'll first start with the Japanese Nikkei index, where it has had the biggest drop in years, and this is because of two factors. The first one obviously is because the Bank of Japan has started hiking rates. Remember, higher interest rate environments are never good for companies, and it usually has a negative impact on stocks. And the second one is the fears of a recession in the US economy, and this is starting to spread out in the global economy. So investors have started being spooked with regards to how the employment came out in the US, and this is starting to make investors exit a lot of these stocks. So we've seen stocks coming down of late, from Tesla to Google to Apple, and this is affecting broader indices across the globe. So the Nikkei is one index that has had the biggest drop, and you expect other Asian stocks such as the Kospi in Korea also to have the same effect. So usually when you have fear and it spreads out through the market, then it becomes a bear trend where investors are sort of moving as a herd in terms of selling stocks and trying to get into safer investments. So this is where the critical juncture of this video is. In as much as we are seeing a rush out of stocks, and we are starting to see that play of fear assets coming into the market. So things like value stocks and things like gold might start taking the center stage in terms of what traders are putting their money in. We've seen a lot of investors increase their stockpile of cash and exit, for example, shares. For example, Warren Buffett with the recent exit in positions in Apple shares. So this is something that will be a trend as we assess how the data comes in terms of the health of the US economy and other major economies around the world. And having said that, we'll be keeping a look to see what else transpires during the week. It's a fairly quiet week in the calendar, and you're looking at one more meeting, which is the RBA, and how that will affect the Australian dollar. However, in the broader sense, a lot of what was happening last week is what is going to spill over this week. So that means we do expect, for example, either consolidations or continuations from the sentiment we had last week. Having said that, thank you for tuning in to this session of the Market Watch series. Remember, if you want to trade any of these assets or instruments, the link is in the descriptions, and see you all in the next one.